Hello everyone and welcome to Day Trader S&P 500, a rare Friday night update for our YouTube subscribers. Again, we want to get you guys caught up with what all of the monthly subscribers were able to see. But I want to first start by thanking those who came to the Elliott Wave Hub. That was exciting. I think that was yesterday. And I'll just show you guys some of the things that we covered in there. I want to show you guys. I explained the Fibonacci time spiral that I started back in 1999. The first one was with the orthodox top on August 24th, 99. And even though the market made a higher high, the market turned on this date, which I projected as a high, and I use that as the orthodox high because the market not only turned from that high, as you can see, on a daily basis, but it happened for so long. I created a weekly chart, and I believe that is here. And not only did it work for that short period of time, but I turned it into a weekly Fibonacci chart. As you can see, it caught most, not all, but most of the turning point highs for 7 years. Unbelievable. I haven't had one do that for that long since, although I've got a lot going now that have the potential. But anyway, that was covered in the Elliott Wave Hub. A couple other things I want to touch on here. Let's go with these percentage rises, and we can show you guys that. Well, Dale, if you could make this work. Okay, most of the biggest percentage gains and price gains in history are during bear market rallies, and we're going through that now. That's why it's important. This bear market from 2007 to 9, the one in 2000 to 2002, and this one that started last year. It'll probably last about 2 years. We would think it would go at least till this fall. But anyway, look at these rises. 10% in 7 days, 14%. 9%, 11% in 2 days. Then you think you get a 24% in 2 days, and the bulls got to think this thing is over, right? No, we've got another lower low and then a 19%. Yeah, bear market's over. Get long. Nope. Goes down even lower. Then a 26% rise. Definitely the bear market's over now, right? The bulls are jumping in. We missed out. We missed out. Look at this big rise. Nope. Lower lows. That's what this bear market does. All these counter trend second or B waves make there's two reasons for it. One, the first primary reason is to make the bulls believe the bull market is back. And with these recent moves up the last couple months, that's happening now. And the other consequence is it shakes out the shorts. Okay, so from the bulls, it's up. I missed it. I'm in. And now you lost money. From the bears, I was short. I'm covering, and everybody loses money. Okay. The other point here is, and I'll show you this with Timer Digest. Unfortunately, they're not in business anymore, but we moved to a long position on March 4th, and this 2-year bear market bottomed on March 6th, and it went straight up from there. Okay, so why don't I just go there real quick? There's that Timer Digest, and at the bottom in March of 09, Woodson Wave Report was ranked number 1 in all 3 time periods, from 3 months to 6 months to a year. Okay, so that's what was going on in there. But you can see here a bull on 3-4, and the market bottomed 2 years later. So we timed that bottom of the bear market to within 2 days of a 2-year bear market. So that was fun. Okay, we don't want to go to there. We wanted to look at some of these other picks here, and we went through that percentage. I'll just show you guys this one here. Okay, when the market goes down, everyone on TV, you watch CNBC, Bloomberg, whatever. Well, they ask if the market's going down. Well, we're long-term investors. We don't look at the 1 day, the short term. Well, long-term investors typically get in at the high and get out at the low. And for this 10 years is a long time, right? That's a long-term investor instead of, day trading or something like that. But if you went with the Woodson Wave Report signals from 1999 to 2009, your $100 would return $231.85. If you invested in the S&P over 10 years, you would have lost $75 for your 10-year investment in the S&P 500. So tops are formed when all the buyers are in, and bottoms are formed when all the sellers have sold. Okay, that's the point of that. So people don't get in at the bottom and buy and sell at the top. They do just the opposite. Okay, and then what else do we have here? I really didn't want to knock that down. And let's see. We had that, we had that, we did that, we did that. And that's the same as this, only with some verbiage in there. And I wanted to show you guys one other thing that we covered on the near term. Back, I think it was on the 9th or the 10th, we had a downside target here of 40.6150, and it hit 40.60. And that was in the wee hours of the morning. I think it was 4 a.m. and this hit right before the market opened. It was the 9th or the 10th. And immediately when that target was hit, I put out another report saying our target was achieved. Now it should go up, and 4104.25 was the actual, and our target was 4103. So that was a nice 50-point move, and this was a nice 100-point move. So caught that 100-point move down, and then caught this move up. Of course, it jiggled around and even went higher, and we'll cover that more in the short term. Okay, so that's what was going on there, and let's get into, I want to show you guys, we put out a report today because the bonds did something interesting. Okay, and I used to report on bonds and nobody cared, but now there's interest. Okay, interest rates are going up, so there's interest, right? Anyway, today 217, I believe today's the 17th, it moved above the B wave high. I think I have that on a previous page. So we resumed our long position on the short term. Okay, we've been in this position, intermediate and long, all the way back to 2020. Okay, so let's get into that if we can. Let's see if we can, let's go over here and let's get into the US 10-year. And here's what I'm talking about. Okay, we had an A down, a B up. Here's where C equals A at 2.975%. And you might be able to see in the red, the 382, I made it bigger, is 2.81%. So we're looking for an A down, a B up, and a C down. But when this move here, and this is the 17th, moved above that B wave high, it doesn't look like this C wave is going to go lower. So in the short term, we're long against this C wave low. But in the longer term and intermediate term, we're staying long. Long interest rates, short bond prices. They go in opposite directions. And you might see this 3 equals 1. We might have to get out here to give you guys a better perspective of the long term. Okay, let's see if we can get it in here. There it is. Okay, so after 39 years since 1981, interest rates went down almost 40 years, and then they bottomed at the pandemic low. Okay, low in interest rates, and they've been going up ever since. And that is one huge percentage gain. Let's see what that is here. If I can get that on here again, I'm going. This will be pretty darn close. Okay, how about 1,136% gain in a little over 2 years, from March of 20 to October of 22. That's a good investment. That's a good return on your investment, wouldn't you say? Interest rates are going up. So if that's 1, and let me get rid of that, I did the math on there, and this is 2, and again, that has to hold. The 3.321 wave C has to hold to make this a 2, and when this gets above this high, 4.335, that's when your wave 3 target comes in. Okay, and it's up there at 7.30, and that would be a minimum target. That's where 3 equals 1, and obviously the 1.618 is much higher. But first things first, this market has to go above there, and this low has to hold. Otherwise, these targets come back into play. So that's what's going on with the bond market. And I really wanted to say, I forgot to mention for the Elliott Wave Hub, I was having computer problems. As you know, I didn't do a report for a while, and I'm getting a new one very soon. But anyway, I went ahead and did all this math first. So when I got done early, and people were asking questions, and I really enjoyed the questions and doing the live analysis on the charts to answer the questions. Maybe I'll do a live session like that where you guys can just ask me about things. I can pull them up and then do the analyzation live. I really enjoyed that, so much so that I want to do that again. That wasn't planned, but I ran a little bit ahead. Okay, let's get into the S&P weekly here. Okay, this is the big picture weekly chart from the January all-time high in 2022. We had 5 waves down for A B wave up, direct hit price and time, and then 1 down, and here's 2 up. And this is interesting here because these B wave highs, all the bulls get excited and the bears get scared and cover. And this is an A up, a B down, and a C up. And this is not the daily, but I remember it hit on the 2nd, and it would have been a nice Fibonacci if it would have hit this week on the weekly, but it didn't. But it still made near a Fibonacci. That's 6 weeks up, which is a Fibonacci 5 plus 1 there. And I've got another turn. Well, just get right into it. We have a bigger turn on April the 10th. That's our next turn date. That might be the end of this 1 down, 2 up, 3 down, 4 up, 5 down for the larger wave C, this one here. See the A parentheses, that's intermediate, B parentheses, and C should be a 1, 2, 3, 4, 5. And so far it's a 1 and a 2. Where is this wrong? If it goes above 43.25, the August low, then it can't be a 2. Always got to know when you're wrong. Let me see this, I think show you the, maybe it's in here. Let me see if I got the sequence in here. I may. Yes, I do. Yes, I do. Let's see here. There it is. Okay, so the next turn date in the sequence chronologically is April 10th. Okay, and this one has a pretty good track record with the most slippage is 3 days. Okay, we have a 2 days there, 1 trading day. So that's been pretty good, and that's from the one that began on March 29th. As you know, I have several of them in here. Okay, so without further ado, let's get back to the charts. I think I want to get into the futures from that B wave high. We've got that 1 down and an A, B, C up for A B down, and a C up. I want to point out the alternate count, excuse me, for you bulls out there. And that way, that labeled this as the 3 down, a 4, and a 5 for the larger wave A. Then we've got an A up, a B down, and a C. C equals A at 44.66. So that move, if it happens above 43.27, would kick this target in, and there's higher targets above that, and that would be like the 1.618. But we'll worry about that when and if that occurs. As you can see, there's that C wave high and the larger wave 2 at 42.08. This would have to break above there. I think we can look at things from that 2-2 high. Yeah, there it is. There's a 2-2 high. We're now looking at an hourly chart. There's 1 down, there's 2 up, and here's all this exciting stuff. Here was that actual hit, direct hit, I'm sorry, and there was another one right in here, and it even went higher. But the biggest point here is these retracements, okay? All these 786 retracements. Let me just illustrate here. We'll do this one here, okay? We can pick any of them, but we'll pick this one for trading purposes here. This is unbelievable opportunity. And then this one's not quite a 786, but well, we'll use it anyway. It's close to it. Okay, yeah, it's right on it. What am I talking about? There it is, 41.88. Okay, so you get a wave down and it starts going up. Okay, here's the 382. If you were going to short at the 382, where is it wrong? Where is this 2 up wrong? It's wrong if it goes over 42.08. Right here, it's 41.40. That's a lot of points, and that's a big place to put a stop, right? If it goes up to the 50% or 55 retracement, that's 41.53. Again, that's a lot of points. That's, 55 points. Say it goes at a 618, which is typical, especially in second waves. That's 41.66. That's 42 points. But if it goes up to 786, which it hardly ever does, Now you're looking at 20 points. So if your stops, where am I wrong? All right, where is the count wrong? It's wrong because 2 cannot retrace more than 100% of 1. So if it goes to 4209, it's wrong. So if you have your stop at 4209, you're looking at 20 points, 21 points. So there is your risk, okay? 20 points. And here's your reward, 4061. How about 120 points? Now, you're not going to get 100% of the move. You might get out here. You get out wherever. Everybody's risk tolerance in trading is different. But that's the huge advantage for the shorts when you get a 786 retrace. And we got 1, 2, 3, 4, 4. We may get more. And then there's a 618, which isn't a bad entry either. But this is unbelievable. A 986. Where was this wrong? This was wrong if it went to this move up here. No matter what you call it, it cannot retrace more than 100% of the beginning of decline, which was 41.8825. Here's 41.8650. If you got in here anywhere around 41.86 or close to it, if you said, well, it's wrong here, and that's what I try to do a lot in my day trading. That's why you'll get a lot of tiny losses, but when you're right, it's like it makes up. Like a lot of professional traders, they'll have 10 trades, 8 of them losses, very small, manage your losses, and then huge gains. So here you've got, if you put your stop where it's wrong, above 41.8825, and you get in near here, you're looking at 2 points. That's $200, $50 a point. I'm sorry. That's $100. That's your risk. Here's your reward. Bang. How about 80 points? Okay, 41.86 to 03, and that's just the beginning of it. All right, and you got another, and you got this, and it could still go lower. So that's the market's been creating unbelievable opportunities on the downside ever since that 2 high. That's the point. Excuse me, of that. It's a trader's paradise. Traders love volatility. This is volatility. It's a huge move down, a huge move up, a huge move down, a huge move up, a huge move down. It's 4 or 5. It's rinse, repeat. Okay, we're having a lot of fun trading with that. I think that's about